Hello, everybody. Welcome. I'm Deb Baxley, and I am co-founder of and board member of NIPE, which, believe it or not, we formed over 13 years ago in 2011, and we've been going strong ever since. I'm also a partner with a payments consultancy called Pagility Advisors, and I'll be your host today. And welcome to our event. Why is Apple succeeding in consumer finance while Goldman Sachs crashed and burned? And we will talk not just about Goldman and Apple, but some of the broader implications in general of tech companies like Apple in consumer finance. And by the way, you may recall, if you're a member of NIPE, you may have gotten this survey, but we did a research survey a couple months ago with Phase 5 research, and this was one of the most highly voted topics for this year. So that's one of the reasons why we were excited to do it. As you may know, we present at these events typically monthly, which are a blend of educational experience with networking within people within the financial services industry. We have a community of thousands of senior execs and innovators in payments, fintech, and banking. Today's event, we're going to have 4 different components. The first is a short presentation on Goldman's history in consumer finance. And then we'll have a short video from a fintech expert, Jason McCullough. And finally, we'll have an expert panel on Goldman, Apple, and tech companies in general on consumer finance. And then we'll have a 20 to 30-minute networking session at the end, where you'll have a chance to meet the panelists and other attendees by doing small breakouts. We'll have about 5 to 7 people in each breakout, randomly put together. A few administrative items. If you have any questions for the panelists, you can put them in the chat window, and we'll monitor those. We'll pick those up as we get to the appropriate portion. If you'd like to connect with other people that's in this meeting, please put your name, email, or LinkedIn information in the chat, and you can save that and retain that information later so you can access those people on the call. I'd like to graciously thank our sponsor, Further Advisory, because we really rely on sponsors to do these events. Also, to remind you, we have additional events coming up. We have an event on cross-border real-time payments, another event on AI for payments, which we are doing in concert with our sister organization, PayCLT, which is based in Charlotte. And in the fall, we hope to have our first in-person event since COVID on open banking trends, probably in September. So please join NIPE or keep checking our website to keep abreast of these upcoming events. And finally, I'd like to ask everybody to turn off their video, the session, and make sure that you're on mute so we don't have any distractions. And we'll focus only on the panelists during the session. Let's start with the history of consumer finance. I will share my screen. Goldman Sachs was formed, I don't know, over 100 years ago. And they always focused on investment banking and trading and high net worth individuals. But in 2008, you may recall, in the middle of the banking crisis, they and Morgan Stanley, by the way, were both reclassified as bank holding companies as part of the TARP bailout that happened in September of 2008. That also gave them access to a Fed funds window. But then a few years later, they had an idea that they could leverage their banking license to generate new revenue streams and reduce their capital risk. So they used that to launch into Marcus. If you recall, Marcus is it started out as their unsecured consumer lending platform. Their first hire was Tariq Halwar in May of 2015. He was from Discover. And pretty much, it's interesting. I was at Capgemini at the time, and I was there working on Marcus shortly after that for a few months, as was the guy that we have our video from, Jason. He worked on Marcus as well. So there were a lot of interesting things going on. And then about that same time, they acquired GE Capital deposit platform. along with a bunch of customers. It wasn't a huge acquisition, but it did form the basis of a deposit capability. Then they shortly thereafter acquired Honest Dollar, which they rebranded to become Marcus Invest in 2016. And they finally launched the online unsecured lending platform in October of 2016. And then in 2021, they acquired Green Sky POS Lending, which is a pretty big acquisition. And at Pagility, we've had some exposure to Green Sky. They do mostly home improvement loans. You know, those loans where it says you can, buy windows or something and you don't have to pay anything for a year and it's interest free. So that's the kind of thing that Green Sky does for home improvement lending. And they have a really slick platform for that capability. So then in 2019, they announced a partnership with Apple, and they launched the Apple Card in August 2019. And 2 months later, the CEO said it was the most successful credit card launch ever. They extended the partnership through 2029. Then the next month, I'm sure you recall the headlines that there was allegations of gender bias in their underwriting platform for the Apple Card. And they also launched a 0% 24-month financing, buy now, pay later kind of a capability in December 2019. And for 2021, 2022, and 23, JD Power ranked the Apple Card as #1 in credit card satisfaction. It was for a segment of credit cards, not all credit cards, but it was like co-branded consumer US credit cards. So it did very well. And they also launched Apple Card Savings in August 2022. But then trouble started brewing in 2022. They revealed that they had $1 billion loss on the Apple Card product. And they also got a probe. They got in trouble with the CFPB, something to do with how they were handling or not handling disputes on the card program. And then they announced in November 2023 that they were going to end their partnership with Apple by the end of this year. And then starting in 2022 and through the last couple of years, they've been reevaluating this consumer finance strategy. And I say somewhat embarrassingly, they announced that they were selling Green Sky in September 2023. So that was just 2 years they owned it. They also divested, this just happened last month, Marcus Invest to Betterment, bought Marcus Invest. And it says, I think in the Wall Street Journal, that they're in discussion with Barclays to take over the GM card portfolio. There have been various rumors about who would take over the Apple Card portfolio. I had some notes on that. And by the way, when Apple was shopping around somebody to be a partner for their credit card, it's said that Citibank, Chase, Barclays, and Synchrony all talked to them, but they avoided the partnership because they thought that due to some of the product features, like the low rates and low fees, would inhibit their ability to be profitable. And then there was also some notes that during this whole debacle with the gender bias, Apple didn't come to Goldman's, didn't say anything about it, so they didn't help them out. And I guess we'll hear more about that this evening. So let me stop share. And I will introduce the person who we have the little video from. Jason Makula, you may have heard of him. He's a seasoned expert in digital banking, fintech, product marketing. He's got a background that spans international startups to Fortune 500, including a tenure at Goldman Sachs, working on Marcus. He brings a wealth of knowledge and experience to our discussion. There's a publication called the FinTech Business Weekly, so he's the voice behind that, where he explores the intersection of technology and financial services. And so he'd be a valuable contributor to the conversation tonight. So Nikki, can you go ahead and tee up the video, please?
Sure. Give me 1 minute.
Good evening, everybody. First of all, I wish I could participate live, but it's a bit late given that I'm in the Netherlands. I did want to share a couple of thoughts, particularly as I was an early employee at Marcus, working both on the original unsecured personal loan product and the integration of the savings platform, which had been acquired from GE Capital. First, it's worth remembering some of the history of how and why Goldman even is a bank. Specifically, that during the 2008 financial crisis, it converted into a bank holding company, granting it the privilege of accessing funding from the lender of last resort, the Fed discount window, in order to help calm markets in the wake of Lehman Brothers' collapse. Post-Great Financial Crisis, Goldman basically returned to business as usual, focusing on trading and investment banking. Meanwhile, its arch rival, Morgan Stanley, set about developing its wealth management franchise, which throws off a steady stream of fee income. Morgan Stanley saw its stock price and its valuation multiple grow, while Goldman, dependent on that cyclical deal flow and trading revenue, did not see the same thing happen. Marcus was supposed to be the answer to this, a boring, steady revenue stream to serve as a ballast against cyclical trading and investment banking revenue. After the launch of Marcus's personal loan business, what it launched with, there wasn't really a coherent, consistent strategy. You had some products that got built that were never launched. You had ill-advised acquisitions. Eventually, with repeated executive turnover, each new leadership team wanted to put its stamp on things, further muddling strategy and leading to execution missteps. While overall the view now is probably that Goldman's consumer foray was a failure, it is worth parsing out some of the component parts. So specifically, the Marcus personal loans business, where I spent most of my time, although not huge, probably did have positive unit economics. The deposit gathering platform is the real piece that mattered in the context of the wider firm. The deposits Goldman was able to gather through Marcus, both in the US and in the UK, substantially reduced Goldman's dependence on expensive wholesale funding, reducing Goldman's cost of funds and improving net interest margin and net interest income. Green Sky, which was some people refer to as buy now, pay later, although the Green Sky product was basically an unsecured personal loan distributed through contractors, home renovation type vendors. If you squinted at the time, that deal could have made sense as complementary to Goldman's lending through Marcus, although Goldman bought at what turned out to be the top of the market and ultimately sold it for a fraction of what it paid several years later. Apple Card, which is what you guys are focusing on today, clearly not a financial success for Goldman. At a high level, I'd put some of the blame there on Apple exerting too much control in the partnership and Goldman being too willing to go along with it because it wanted that deal, that name, to anchor its ambitions in the co-brand space and in the wider banking as a service space. Some examples of Apple exerting that control, perhaps most importantly, was the credit quality or the credit box of consumers, applicants that Goldman was approving. If you look at the 10Qs, something like a quarter of Goldman's credit card portfolio, which was primarily Apple, but also included the GM card portfolio later, something like a quarter of that was subprime. If you compare that with the lending that Marcus did that Goldman did under its own Marcus brand, virtually none of that was subprime. So you had Goldman playing in a space that, frankly, it was not particularly familiar, both revolving credit and subprime, that was, quite obviously in retrospect, a challenge for the firm to deal with. Another example, the billing cycle. Apple wanted everyone's billing cycle to be a calendar month, which for a user is a good feature, but for the bank handling complaints or calls caused problems when Goldman's customer service center would receive a spike in calls or complaints each time the billing cycle closed and statements went out. I'm sure you guys will all unpack these topics and more. I'm sorry I can't attend live, but hopefully next time. Good evening, everybody.
Thank you, Jason. That was really good. So, our
I did
We're
want to share
very,
a couple of thoughts, particularly as I was an early employee at
oh,
Marcus,
Nikki,
both on the
it's playing
original
again.
unsecured personal loan product and the integration of the safe.
There we go.
I'm
So we
sorry.
have, okay. We're fortunate to have two other experts in person, Brian Riley from Javelin and Kate Fitzgerald, who I'm sure you have all seen on American Banker. And I'm going to ask them to introduce themselves first. Brian, you're on mute. There you go.
Thanks. Hi, I'm Brian Riley. I'm based in Tampa, Florida. Long stint in my career with Citi, Chase, and Wachovia, all the time in retail payments. I joined the analyst community with a company owned by MasterCard in 2006, and I'm currently with Javelin Strategy and Advisory. With that, I'll pass over to Kate.
Kate Fitzgerald. I'm a senior editor at American Banker, previously Payment Source, and for many years I've covered credit cards. In fact, I have to throw this in because I'm not young, that I actually wrote my first story about Discover in 1988 when they first turned a profit. And I really have been covering credit cards on and off ever since, but the world we're in now obviously is digital and it includes a whole lot more than credit cards. So that's my beat.
Right. And I guess we would be reminded that Goldman would not be the first new to credit card issuing that lost money. There's been a whole history of different companies that have had trouble with it. So anyway, let's start off with Brian. Brian, what do you think was Goldman's initial goal when getting into consumer finance, and where do you think their strategy started to diverge from their traditional strengths?
I think they underestimated the complexity of the consumer business. And it really, consumer credit requires a lot of discipline when you're getting in. One of the challenges they had was that I think Apple's a pretty tough partner. It relies on having its own ecosystem. It expects to be the center of the universe. And really, it's not they should have looked into some history with Apple's prior card with Barclays Bank, which didn't do too well. That preceded the relationship with Goldman Sachs. And they tend to be a very tough partner, and they certainly do have a large account base. But that can't compromise the standards that are required in consumer credit. And I think that's where things really fell apart. That Goldman Sachs may have been a little bit too aggressive, getting into the co-brand business, expecting a big boom as they built the portfolio quickly, and not looking at the basic curves. When you're acquiring accounts, there's an acquisition curve, and you're going to peak at about 12 months in your write-off, but not building and stabilizing and maturing that business quickly enough. It was a little bit too fast-paced, and I think it lacked a lot of planning.
Hey, did you have any comments on that question too?
We'll probably build up. We'll circle back on that when we get into the strategic missteps part, I think.
Okay. I was kind of surprised to hear Jason say that. Did he say 20% of their portfolio is subprime?
About 25%.
Geez, because I wouldn't think as people who own iPhones as generally subprime, but I guess maybe that's the reason they're subprimes, because they spent so much on their phones, right?
I was in motor vehicles about a month ago, and I have an iPhone XS, right? It's 5 years old. It's all paid for. And I'm around a bunch of kids, and everybody's got a current iPhone 15. Just because you own an iPhone and you have parents that are willing to pay for your phone, or you can finance it somewhere, doesn't mean you're going to pay your bills.
Right.
And that's one of the important things when you look at the demographics. Certainly if you look at some of the income demographics I've seen from iPhone owners, about a third of them have incomes less than $50,000, right?
Wow.
So that really limits a whole level of the population. You talked before about the debacle they had with the credit scoring and the gender bias. It's kind of like ready, fire, aim on a lot of the strategies. And I think that's something that's bled through.
Yeah. I mentioned that I worked on Marcus, so it wasn't the Apple card, but they mentioned Barclays was an earlier partner. And one of the senior executives, there's Harit Talwar, who was from Discover, Bo Hartman, who joined Marcus as the CFO. So he was one of the top 3 people. He was from Barclays. So I don't know what happened when they were in the partnership discussions with Apple, because that was after I was there. So one funny thing I kind of wanted to mention is we all worked in one huge room. There were hundreds of people working on Marcus, one room, no offices. And I would say 95% of the people were from the outside. They weren't from Goldman. Well, I guess it makes sense because Goldman didn't have the expertise in consumer finance. But a lot of them, maybe half of them, were from American Express, because I guess American Express had just done a layoff, and they were right across the street, literally across the street from American Express. And one of the funny things that happened, they had to integrate with the Goldman Sachs overall ecosystem, but Goldman only had high net worth individuals. So one of the things they thought they would have to do for onboarding was check, they called it politically exposed persons, PEP. So this would be somebody like, Vladimir Putin, or somebody who was politically exposed as part of their KYC, their know your customer and anti-money laundering efforts. But I've never heard of anyone looking for politically exposed person in a consumer portfolio. So that's just a small example of the kind of culture clash between Goldman's traditional business and Marcus, getting into consumer finance. So Kate, we've already touched on this, that Apple has this wonderful ecosystem with Apple Pay, Apple Card, Apple Savings, Apple Pay Later, Apple Cash. How do you think they leverage their ecosystem and brand appeal to outpace traditional financial services?
Well, this gets at, why is Apple succeeding in consumer finance? And, it was years in the making. Apple Pay itself was years in the making. All these different consortiums had tried. The NFC chip was available. The technology was available. The merchants and the banks could not get on the same page. What was in it for which parties? And when Apple finally made its move in October of 2014, it ignited something finally that had been this huge unmet need to use this technology, and all the merchants finally started switching it on. So Apple came in with this momentum in financial services as a playing a key role, and they got all kinds of bank participation right off the bat, even though a lot of banks allegedly were nervous about what it was going to cost them. They were worried about losing their identity inside of Apple Pay, but eventually they got on board because they didn't want to miss out on the potential that Apple, with its cachet, with its upscale base, with half the telecom handheld user base. And even though rumors have held consistently that banks pay 15 basis points on transactions, and they hate that, it actually benefited banks to participate. So there was a real strong base from Apple Pay. From there, the Apple Card seemed logical, but if you look a little deeper, Apple already has been doing a lot of private label financing with other banks. They have a thriving relationship with Citizens Bank to let consumers finance Apple Pay purchases. I don't know how far back it goes, but there are several other lenders that Apple has worked with before they launched the Apple Card. They had experience financing these devices. So this isn't their only layer. The Apple Card came along as it seemed like a really natural fit, and it had these novel features. They wanted people to use the app, not the card, because that would drive more usage, and there'd be a more likely, it would enhance Apple's ecosystem, which then led to Apple Pay Later, a short time afterward. I guess Apple Cash was right around that same time. And since they launched Apple Pay Later, it has been relatively muted, very different than the Apple Card, which had this huge splashy launch. And a lot of people had the feeling like, oh, this is a must-have product. Its rewards were good, not great. If you use the Apple Card for every purchase, you're getting a really strong average rewards, but they only have a few key partners. So strategically, if you're going to use it to buy Apple products or go to Walgreens or a couple other merchants, you can really reap some solid benefits. But Apple Card didn't offer the very best benefits, even though I don't think there's an annual fee. So it's a kind of a really good upper to middle of the road product. Apple Pay Later so far is pretty bare bones in terms of a buy now, pay later. Last I checked, they only offered a pay in 4 mode. And I think the ceiling was $1,000. They might have lifted it, but the initial ceiling for borrowing was only $1,000. That's not going to get you very far. I'm not quite sure what their goal there was, except to experiment, test the waters. Maybe that was part of their effort to see who these borrowers are, what kind of base they have. Apple Cash was initially sounded like something would really take off. I have always struggled to get people to use it with me. My hairdresser won't take it. Everybody, they know Zelle, they know Venmo, but they don't know Apple Cash, which makes no sense because Apple Cash would be a great place to accumulate your benefits, build a balance, and then use that for shopping. Maybe more people are using it than I think, but in my experience, they're not really, that hasn't really caught on. Apple Savings, apparently they've racked up quite a bit of capital through that. Makes a lot of sense. They have a very competitive rate, but not the very best rate for high yield deposits. And everybody else is doing the same thing. So there's nothing particularly unique about what Apple Savings is doing. But each of these things has kind of had a different trajectory, a different goal, and a different outcome, and a different way it's being positioned. The only one that ever really got a lot of marketing support was Apple Card. And that was really initially. So far, I'm not sure that Apple has done a great job of cross-marketing these different things, because some of them have kind of fallen below the radar.
Right. I have, well, when we were on the prep call talking about Apple Cash, I realized I've got a whole bunch of money in it. I don't even know how I got it and what I can do with it. So I find the whole thing a little bit confusing. But going back to Brian, from a research perspective, what do you think were the most significant wins in the partnership between Apple and Goldman, particularly in technological integration?
I don't think there were many wins. There is an elegance to the design of the Apple Pay. Having it pre-installed on phones gave them a good base to work with. I didn't think that the card met the promise of the best credit card ever to exist. You think of things like the billing cycles. You really don't know the business if you bill all your customers on the same day, right? I mean, it's a fundamental piece. When you talk about people coming from American Express, as an example, they know billing. They know multi-currency. They know the whole flow of a call center. And there's, Monday are peaks, days of months are peaks, and it's very predictable. But it just says they were trying to re-engineer a little bit too much. You look at if the demographics showed that a third of their customers have less than $50,000 in income, these people are probably being paid every other week. So like 2.3 paychecks a week. That doesn't fit in with everybody bills on the first of the month. It's just inherently a miss. When you look at things like the big deal about the payment of the reward points, I use my Apple account for Words with Friends, McDonald's app, and things like that, debit card type transactions. And so I generate at the most probably about 30 cents a day in rewards. I can live without getting those distributed every day. Though I do think that those rewards have helped feed the savings accounts because it is easy to move money into that. And that's probably something that's given a lift. Kate was talking about the rates. Last time I checked on Apple, they were paying I think it was 4.17, which is a good rate. It's something that is easy for the market to use because it moves so easily on the account, and that's a benefit I think people get and they probably don't even realize. And even though they have, I think they're in the range of over $10 billion in savings, it'd be interesting to see the curve on it too. I don't see a lot of these transactions. The ones that revolve on Goldman Sachs's credit card, as far as I know, are the lower FICO tranches, and that's the last place you want to do it. And the whole revenue stream becomes very unsound, and it's a castle of sand because you're generating your revenue from your weakest segment of the portfolio.
Yeah. It's interesting that I think Jason said most of the Marcus unsecured loans were prime, whereas the Apple Card holders, a big portion were subprime. And the purpose of the Marcus unsecured lending was to help people pay off credit card debt. And I would, I don't know, it just seems kind of bad.
That's always a rocky area within consumer payments because you have.
Yeah, but you would
see
think it would be more subprime than they were. So they were more careful with their underwriting for the unsecured loans than they were for the Apple Card, it sounds like.
Well, I think one of the things is you can kind of beat the curve on your credit score as things start to deteriorate. You can go refinance that, and then your scores get the benefit of paying that down. You know, you've done things like decrease your utilization rate, and you've shielded from the delinquency. So that would not be something uncommon.
Right. So, Kate, what are some other strategic missteps that you observed in their approach to consumer finance compared to traditional banks? You're on mute.
Some of the things the operational mistakes were their fault, and some were not their fault. We've talked about their lack of experience with consumer underwriting. Let's just take a minute and acknowledge that consumer underwriting there's an art to it. And the companies that have been doing that, like Synchrony and Bread, formerly called Alliance Data, have been doing that for decades, and they have a lot of data and a lot of expertise in when to pull back and when to extend credit and how to forecast and how to handle and read the ups and downs of delinquencies and what you're getting there. They didn't have that background. There's a lot to it. You know that the companies that specialize in that, when you hear them describe how they survive different ups and downs, they have all kinds of patterns they can observe. I guess you can hire people that know that, but there's no substitute for the actual experience and the data that you have in-house that some of these lenders have. So they didn't have that. So they're working with kind of their customers are a mystery. That's a problem. And I don't know whether they could have hired different people or tried a different way of drilling into trying to get a hold of that kind of expertise. But I do know one small anecdote was that a guy who was a real Apple fanboy was very excited about the Apple card, and he claimed to have pretty good credit. He could not get a card. And now I don't know his FICO score, but later hearing that they were willing to take lower FICO scores, and I know this guy is I know he has a job, he buys lots of Apple products. So then he got turned away and he was very bitter. So that was a strange story. That was just one example.
Reverse gender bias.
Yeah, I mean, he was an Apple fanboy to the max.
Yeah.
Okay, so another problem the thing to factor in is the fact that they came out with this 7 months before COVID. That wasn't their fault. I don't know how you could measure that, but it certainly was a curveball, and it would have interrupted the momentum of some revenue streams. You look at Amex's spending from the first quarter, I think really hit the second quarter of 2020. It was an unbelievable plunge. It was a huge drop. And then of course, a couple of years later, they surged back. But that had to have had an effect on them, especially because they were new. So here you're getting knocked down. The other thing we know about underwriting and marketing of credit cards is each of these other companies that we look at, like Bread and Synchrony, they have a lot of levers to pull in stores that they work with, and they can do promotional offers. They can offer things specifically to certain categories of consumers, or they can have an outreach, or they can respond to people. They can increase and lower promotional balances and deals and whatnot. What are Apple's levers? What kind of marketing did they have within their base? I don't know what they were. I feel like they didn't have a lot of the levers that your typical middle to lower middle consumer lender has.
Got it. Okay, Brian, maybe we've already talked about all of these, but the financial pitfalls that Goldman faced in the partnership, especially concerning loan defaults and interest income. Was there anything else we could add?
I think the big deal here is that this was a bad marriage to start. And I really believe that. I think that Apple has a lot of market power. There's no doubt about it. And that Goldman Sachs was probably too accommodating in the whole process. When you look at what makes a good co-brand relationship, and there's lots of great examples. Citi and Home Depot have been together for 40 years. Delta and American Express have been together for almost that long. American Airlines and Citi is that long. But it's got to be a partnership. And you can't force things down the pike just because you want bigger sales. And it's a classic example between, credit doesn't want to book anybody, sales wants to book everybody. And you see those failed relationships if you look at the Walmart relationship. They were with Synchrony, and Synchrony does know how to run a co-brand business. There's no doubt about that. And that fell apart. And it fell apart because Walmart felt that they were not approving too much. And that's what I think happened in the background with Apple and Goldman Sachs, is that they wanted people through the pipes. They wanted to bang out cards. And not everybody, like I said before, that has a $1,400 phone is worthy of a credit card. That's the bottom line. And that didn't work. And Goldman Sachs was reticent to say no. And you could see that as evidenced in their losses in that 2022 period that you're talking about. And I don't think they've been doing that well even since then. So it was just not well founded that Goldman, it was a learning experience for Goldman. And it was an expensive one. And I think if you look at who's going to be the next buyer on this portfolio is going to be interesting, because it will have to be deeply discounted. It's not something that would seem attractive to a Chase or to an American Express. They have well-run businesses, and they don't need to drop in tons of unstable accounts. And that's what you've got today with that portfolio. So backing out of this will be really an interesting thing to watch in their financials.
Right. And I listen to a lot of podcasts, and they're still advertising the Apple Card on podcasts. I don't know if they're advertising it anywhere else, but
Oh,
so Kate, we already talked about all of the statements coming out on the first day of the month. It wasn't probably the best choice. Has there been other operational conflicts that you would want to mention?
well, I actually was thinking about the Apple's exacting standards for design, look, and feel fits into that, the dictating the date of the statements. But that's just the tip of the iceberg. Try to imagine what else that implies in terms of the rigidity of working with Apple. It is pretty well known that when you partner with Apple, a lot of people thought, oh my gosh, what a golden partner. And that many partners were disappointed and went away. They were disappointed, or they lost money in their Apple partnership because Apple drives such a hard deal in everything that they do. So if you don't have any wiggle room on these things, that the actual lender is you're restricting them on little things. Probably we can't even imagine what they are. We just know that Apple would be inflexible on this. Then we flip over to look at what we do know about credit card issuers and how challenging it is. I mean, it's not as if there's the profit margins on these lower to middle FICO credit portfolios. Correct me if I'm wrong, Brian, but I don't know what they're expecting, because Synchrony and Bread, who are in this market, who operate very similarly, and they have co-branded cards. This is not the most lucrative industry. I mean, it is lucrative. Everyone says credit card. I've heard it said that credit cards is the easiest money you can make. You've got this built-in interest rate, but it is you got to run a tight ship, and in order to keep showing gains. So you need to be very, very, very strategic. And I see that they, lacking the flexibility that they might have needed, and the lack of any cross-marketing leverage, and Apple's sort of closed door secrecy that surrounds their operations doesn't give the partner that wiggle room that they need to perform the art of turning a profit. Brian, what do you say about the profitability of a middle of the market consumer card portfolio?
Well, when you talk about Synchrony, it's a great example, because, and the same thing goes with Bread or Commodity, because they are playing the outer limits of FICO scores when they book accounts. It's just a fact that They go to lower margins, but they also price for risk, and that's important. And it's something that you're going to see in a current issue too, as if the Card Competition Act comes in, or when things like the fees, if late fees actually do go down to $7, because lenders have a business model, and that's going to cost $8 billion in revenue. So what you'll see is lending will start to tighten. Those FICO bands below 660 that we're getting credit cards, that number is likely to go to 680. And it does create a havoc. If you really look at the real effect, merchants will feel it because people will have less open to buy to spend. Consumers won't have the relief of credit cards, and it's just part of the model. And the same thing goes when you're doing the whole distribution of credit lines around this Apple portfolio. You have to account for each. This is a very disciplined process that is highly sensitive to things like credit scores and buying habits and purchasing habits, because the lower quality credit will revolve a lot and generate lots of money. But you don't want to make your money there. You want to make your money on transactions. Going back to American Express, going in their long history has been to focus on spend-centric customers, right? Because it generates a lot of fees. It keeps the risks low because people pay back their bills. And when you have a snap in the economy like we do now, we know that people are borrowing a lot more money. They're carrying over things like milk and eggs on their credit cards, which is a mess waiting to happen.
Just one more thing about the partnership. When I look at the more successful co-branded partnerships that Synchrony and Bread have, and Barclays, actually Barclay card, is they're with a partner. I mean, Delta is, people have a lot of loyalty to flying on Delta, whereas do people have a lot of loyalty to a consumer electronics product that they buy from time to time? There does seem to be something missing in there's how much are you going to care about you can prefer this, but it's more like a necessity. Most of the other co-branded partners, there might be retailers, there might be a video game marketer. You're going to want to get not just cash back, but you're going to want to get perks, which you get with an airline or with a hotel or with Barclay card has a bunch of retailers. You're going to get extra things. You don't get anything extra if you're using your Apple credit card. You're just getting 3% cash back for paying. Where's your special prestigious, passionate connection to Apple? Do I get invited to the headquarters to meet?
I love my Apple phone, but it is 5 years old and it's paid for. So, but if you look at the bankruptcy filings that Delta went through a few years ago, it really shows you the strength of the relationship they had with American Express, where American Express bought tons of reward miles in advance to fund Delta as they were going through the bankruptcy. And that's what a co-brand relation, this is a business relationship. It's a joint venture in many ways. When you look at some of the cards, not many cards have failed, but if you look at something like the AT&T card that try to do it all on their own, and they won the Baldrige Award the first year. And a lot of people from Citi, when I was there at the time, migrated to that business. And I know it well. That was, we can do it all by ourselves. And that's not what payments is about. That there's competition in this business, there's co-opetition, and it's all dependent on a network. And when you try to play big dog, whether you're Walmart or Apple, it's not going to work with partners. And you could just see them going through and look at some of the successful ones. Some of the Synchrony ones have been around for years and years and years. And that's the test of a successful relationship, that your partner's got to make money too, not just you.
Well, and there has to be an incentive for the consumer to use that card to keep it top of wallet. What's the incentive other than getting cash back? I mean, I see a parallel between AT&T, Universal, and Apple in that it's a kind of a utility. This isn't a passionate thing where I'm going to go to a tropical island, that I'm going to get to go to Carnival Cruise Lines, which is another Barclay. They've got 3 cruise lines. That works because people want to keep paying and using that card, keeping it top of wallet. There's something lacking here, which that they're going to have to solve if they're going to make this go with any other partner.
And you break the longevity too by paying those points out every day, right? I mean, it's like, I have some points that have been accumulating for years, and I purposely, and there's others that I pull out quickly because they're tied and I have uses.
Because you've got choices that you can't assume that the consumer is just going to use the Apple card because they have this generally positive feeling about Apple products.
And Joe Sixpack in America has multiple cards. He or she have 3 cards, And one's the transaction card, and one's the, oh my God, if the transmission goes, I need a safety net. And there's multiple cards and people dedicate them. That's why, currently we have an adult population of 230 million and there's 600 million active cards.
Well, we're coming close to the end. I have one question. If people would think about what other questions they have, but I'd like to turn this from not just Apple and Goldman, but what does the example of Apple say about the potential for success of other tech companies getting into consumer finance?
I'm going to jump in on that. I had taken some notes on that. I have just finished analyzing the first quarter results of Block, PayPal, and Affirm. These are fintechs. Each of them is doing something that's not unlike what Apple has done with its ecosystem, in that Block has created a triangle between Square, Cash App, and its buy now, pay later subsidiary Afterpay. And they want to have each of the legs of this stool feed the other one. So the Cash App user is discovering Square merchants and also getting prompted to finance things through Afterpay, all within the app. And they have a debit card, and they're trying to work kind of a super app atmosphere there, which is what we kind of thought Apple might do if it had really pulled the ecosystem together. PayPal has a similar situation. They've been struggling to ignite with Venmo and their super app that they keep kind of retooling with Honey, with discovering deals. And they've got, you've got a high yield savings account. You've got all the pieces of the puzzle, but they're on the verge, and they're quarter after quarter, they're on the verge of breaking through with that. Then Max Levchin over at Affirm has the Affirm Card Plus, which he's been describing it as neither a credit nor a debit card, which came clear yesterday when Visa announced its new flexible credential, which we wrote about. And Affirm is the first, they're piloting it. This is the new hybrid approach. Again, Apple has the potential to do this because they have all of these elements with Apple Cash, with the card, with the savings account, and potentially to connect to other merchants to create more of a flywheel. So these three fintechs are now formidable contenders for banks that are already putting out your more traditional credit card. They're more flexible, they're in the app. In many cases, they're going after non-traditional borrowers, which that might be Apple's customer.
Brian, you have any comments on this?
Yeah, I think that fintechs need to keep in mind that it's not as easy as it looks, a successful operation. Because while all Kate says is true, you still have things like potential merger with Discover and Capital One. That's a game changer. You have things like Chase looking in France and branding with CB in a private network that's not MasterCard and Visa, right? So that's one of the exciting things about payments. There's a lot on the horizon, and many people who think that they have a good shot will go through a lot of stress. Affirm still is struggling on their revenue side. If you look at Klarna, a lot of stress there. It's tough to bear the risk that many fintechs get into the picture, because they're going into a settled model. It's like alternative scoring. It's a great idea, but if you get outside the boundaries of what are used in fair credit reporting, you get a very different model. And those foundations have proven steady in the US market for decades.
So I want to add another thing. Even as these fintechs start to spin up what looks like a really interesting modern digital super app, in-app kind of challenger, we see the revenge of the banks. Visa's flexible credential gives banks a way to get into the fintech delivery model of provisioning a card at the point of purchase as credit, debit, virtual, pay later. And you also see that several years ago, MasterCard announced MasterCard installments, Visa announced Visa installments. They've built these, don't discount the network's ability to deliver what the fintechs are doing and then go a step further, because where is the most natural place to store your money, to fund your purchases? Your bank.
Yes. You had some comments about the new CEO of PayPal really changing their strategy quite dramatically because he came from Intuit, right?
That's
Really
right.
focus on small business.
The new CEO of PayPal is named Chris. I always forget his last name, but he's Alex Chris. He is known as a turnaround guru. So PayPal's been chugging along quarter after quarter. In the most recent quarterly announcements or discussion with analysts, Alex Chris said that PayPal had dropped the ball in several areas, which is quite an indictment of our friend Dan Schulman, who was viewed as a superstar. So he is now going through PayPal one by one and looking what's he going to push on. And that actually, thanks for reminding me, because they decided that they are going to salvage Zoom, XOOM, the cross-border subsidiary that PayPal has. I don't know if Apple has tapped this or plans to tap this, but cross-border payments are one of the hottest areas of innovation and development and potential and competition. And Apple could play in that sphere too. So that's something to keep an eye on. Maybe Apple hasn't even tapped all of the legs of its potential ecosystem.
Right. And I will remind you that we have an iPay event on cross-border payments coming up. I think it's going to be in July. So, Ankit Patel, I may have to have you come off mute and clarify this question, but in any commentary trying to build a new business like platform solutions within a larger successful organization like Goldman that creates extra pressure, business unit hit numbers that actually matter across the organization, growth at all costs dilemma.
Yeah, absolutely. So it's, Goldman trying to spin up a unit in Marcus. It's really competing against Goldman's investment banking arm and asset management. So for that business to make, let's say, $500 million a year, it's a big who cares. So the pressure put on the execs that are hired by the Marcus teams, the platform solutions teams, scooping up the likes of Green Sky, building out Apple Card, it's, does this move the needle? Does this matter? And so, it's, hey, we acquired 1 million users. Like, okay, not good enough. So the pressure really there is to do more and acquire customers at scale, offer products that are no fees to entice people. And so, the metrics that a lot of these executives are managing towards is really growth, less so on profitability. And then here we are 2-3 years later, it's, guys, you lost $4 billion. Like, what happened?
Well, yeah, because the fintechs, they can lose money for years and everyone thinks that's okay, but not so much banks, right?
Yeah.
Banks or regulators, because
Yeah.
banks are in it for the long haul. They're subject to things like liquidity requirements and stability with customers. If you look at the objective of a bank is to get in a household and grow, right? And go through the whole life cycle and get into shelter product. Once you get in with a credit card, you get deposits, you build other loans, you do, ultimately retirement accounts. And that's really a different model than a flash in the pan, I want to be a lender, right? That becomes a single threaded hole that just doesn't exist or survive, at least.
I guess it explains why Goldman had so many acquisitions. They were trying to grow through acquisitions. So any other questions from the audience? Thanks, Ankit. That was a good question. All right. Well, Brian and Kate, this has been a great, fascinating conversation.